Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today we're going to discuss a covered call. A covered call is a way with which you can earn income while owning a stock. In this video, we're going to be actually looking at risk-reward graphs of both an individual stock, as you can see on the screen, as well as what a covered call would look like. So on the screen, you can see that if you were to buy 100 shares of stock at $20 per share, your cost would be roughly $2,000. Now, of course, if the stock goes higher, you would make money as the stock goes higher. And if the stock were to decline, then you would lose money as the stock were to go down in value. This is pretty simple, but now we're going to show you what a risk-reward graph would look like if you were to do a covered call trade. So a covered call, as with any investment opportunity, has a good part and it has a bad part. Let's go over the good part first. As you can see in this drawing, you can see that we are getting a $25 credit. Now that credit is yours to keep now, always, and forever, regardless of what happens. However, you give up an obligation. We're going to talk about the credit first, and then we'll talk about the obligation a little bit later. First off, this covered call that I'm showing is for 3 months out, and it is out of the money, meaning that the strike price that you select, in this case 25, is greater than the current price of the stock, which is 20. So you're investing $2,000 into the stock by buying 100 shares of it. 2,000 divided by 20 is 100, and that's how we come up with that number. We try to keep things as simple as we can. And what you're saying is that you're willing to sell the stock at 25 if called upon to do so anytime between now and the next 3 months. So with that, you can also do at the money covered calls. You can do in the money covered calls. You can do 1 month covered calls, 2 month covered calls. You can select different time frames as well as different strike prices. But for today, we're going to be using 3 months, and we're going to be going with an out of the money covered call for this example. There'll be other videos on time frame selection as well as strike price selection. So with this, you invest $2,000 and you're getting a $25 credit. That comes out to a little over 1%. Now, 1% over the course of 3 months, if you annualize that, it comes out to close to 5%, or it comes out to exactly 5% if you do 25 times 4. Now, with that being said, does this mean that you're guaranteed a 5% return on your investment? No, not at all. But what it does mean is that you are guaranteed a 1%, a little over 1% yield over the course of 3 months. Option prices can change from month to month, so you're not guaranteed that you're going to get this price the second 3 months that you get the first 3 months. Now, with that, let's go over the drawbacks of this trade. Of course, it sounds wonderful getting this 1% no matter what, and you have that no matter what. But with that credit comes an obligation. And what's that obligation? Well, you'll have to hold on to the stock until expiration if you want to get the full credit. Meaning that if you don't have the stock and you have to sell it, and all of a sudden, let's say the price of the stock goes up extremely high, then you're going to have to buy the stock and then sell it at a higher price for a loss. And that's just something we're not going to get into right now. So with a true covered call, have the understanding that you're holding it until expiration. Next, the other downside to this is the fact that you do not get to participate on any upside past 25. So if this stock were to go to 30, 40, 50, whatever the case may be, you're obligated to sell it at 25 if called upon to do so. So that's another disadvantage of a covered call. Now, I like to tell people that if you do get to that level, the maximum profit, if you will, it's a good thing. And if you're concerned with missing out on that much of an extra profit, this isn't a good strategy for you. Finally, the main disadvantage of a covered call trade is that you have to hold it until expiration, or I should say, you don't get the full benefit until expiration. So in other words, you're obligated to sell the stock at 25 until expiration. Now, most of the time you get out of trades like this a little bit early. You'll buy to close the covered call, but we'll be covering that in a future video as well. So have the understanding that when you're doing this trade, you're going to be holding the stock until expiration, and you're going to be giving up the upside past the strike price, in this case 25, that you are using. Also, you have the risk of the stock. So, yes, you get the $25. However, if the stock were to decline in value, your investment would decline right along with it as if you owned the stock. So, have that understanding. If you are looking for a financial advisor who does strategies like this, if they are appropriate for the individual investor, feel free to reach out to me by checking me out on my website, stcharleswealth.com, or you can follow me on Twitter at Mike Tusaw. Thank you and have a wonderful day. Bye-bye.